You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Dana Peterson, Center Leader of the Economy, Strategy, and Finance Center at the Conference Board. I'm also your guest host for today's episode. Joining me today is Stephanie Richard, who is the Senior Economist of Global Economic Indicators at the Conference Board. In today's conversation, we will discuss the latest Consumer Confidence Index as well as our outlook for the global economy. Welcome, Stephanie.
Great to be here.
Okay, Stephanie, let's dive right in. How are consumers feeling in July?
So in July, consumers are feeling a bit more confidence than in June, but overall, they have kind of entered a wait and see mode since May after the roller coaster that we saw since the end of last year.
So are consumers still concerned about tariffs?
Yes, they are. And, we've been asking them for a long time what is driving the most their views of the economy. And overwhelmingly since April, it's tariffs. And they are very still concerned about tariffs, especially they are worried that tariffs are going to lead to higher inflation going forward.
And so tariffs was definitely number one on their list of concerns. What was number two?
Inflation.
Yes.
and in fact, we've seen some increase in the references to inflation. So we already have this story of consumers being very worried about how tariffs may lead to higher inflation in the months to come. And I think that's their main concern going forward.
Thank you, Stephanie. Just looking at the details of the report, was it the present situation or expectations that drove the change in the overall measure?
So the overall measure improved, and this is really the result of better expectations. We saw some increase in the three dimensions of the expectation index.
So it seems like all three aspects of the expectations index, which includes business expectations, income expectations, and also labor market expectations, improved slightly. What about current conditions?
So current conditions, they decline a little bit, and we have a diverging evolution of the two components. So we got an improvement in consumers' assessment of the current business conditions. However, at the same time, we got a deterioration of consumers' assessment of the labor market. And overall, so this component has been deteriorating for now 7 months. It's at its lowest since March 2021, which was just, the middle of the pandemic. And basically, consumers are telling us that they see that job availability is deteriorating slowly. It's still in positive territory, which is good news, but it has been deteriorating for the past few months.
Yes, indeed, the labor market actually has been quite resilient despite all the uncertainty. But we are seeing the unemployment rate see a little bit of a stickiness and even tick up a bit. So it makes sense that consumers are feeling that way. So did you see any material differences in confidence across incomes and age groups?
So in terms of age group, we saw some improvement for age groups above 35. So consumers aged between 35 and 55 and over 55 reported an improvement in confidence. Younger consumers, so below 35, we saw a slight deterioration in confidence. In terms of age group, in the month, it improved for all age group except the lowest income group, which is consumers in households making less than 15K a year.
So I noticed that you've started tracking confidence by political affiliation. What did we learn in the July survey?
So in the July survey, we can see that the improvement in confidence is really driven by among Republican consumers. Their confidence improved in the months where it was stable for Democrats and for independent consumers.
So overall, are consumers anticipating a recession within the next 12 months?
Overall, we still have more than 2/3 of consumers expecting a recession in the next few months, but that's it's lower than it was, for instance, in June, when we had 70%. And this is a new measure, so we don't really know what's the bottom of this measure. It's difficult to say whether over 2/3 is a good number or a low number. What we can see is that it's lower than earlier this year, but it's higher than it was last year.
Thank you. Was there any good news in this survey?
Any good news in this survey? I think the good news, which is still, something that's holding up the survey, is consumers' expectations about future income. This is the only expectation component that is in the optimism category. And overall, it means that, even if consumers are worried that the labor market may deteriorate going forward, they are not especially worried about their own income and about potentially losing their job. So that's the good news. This is the supporting pillar of the survey for now.
Yeah, and I think that definitely shows up in your questions about personal finances, both now and in the future. So, what about the stock market? Are consumers optimistic on future stock prices?
So, the stock market views of consumers about the stock market has been also going on a roller coaster this year. It's really peaked earlier in the year, then it really went down to the lowest level since we started asking the question in 1987. This was for the month of April. Since then, it has recovered. We saw a strong recovery in May, especially after the deal between the US and China, and it's still on a recovering trend. So overall, we see now more consumers expecting stock prices to increase than consumers thinking that stock prices are going to go down.
Okay, well, that's great. Going forward, are consumers changing their plans for purchasing big ticket items?
So they were quite mixed on big ticket items in the month. We saw some decline in intentions to buy a house or a car. And regarding big ticket items, it really varied from one good to the other. There were a bit more higher intentions regarding electronics, but they were really mixed regarding appliances.
And what about services? Are they expressing greater interest in buying more services
So that's
going
the
forward?
area where we saw some caution this month. We asked consumers whether they are planning to buy, services going forward. We saw a decline in intentions overall to buy more services, and this was across all service category, but it was especially concentrated in areas like dining out or traveling, like transportation for personal travel or lodging for personal travel, like hotels and motels. So there is clearly a softening in these areas, which are, mostly discretionary spending. So we can see that consumers are more cautious, and they're going to be especially cautious about discretionary spending. We also see it in our question about intentions to go on vacation, which has declined somewhat this month.
Wow. So basically, consumers are telling us that they're still very concerned about the future, um, but they still feel confident about their finances. And while they are being very conservative about their spending, and even their spending plans, their expectation for recession has receded somewhat. So I think that's better news than we heard earlier this year, but certainly very interesting news. Thanks, Stephanie, for that. We're going to take a short break and be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate ESG? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge, from economics, marketing and communications, ESG, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. I'm Dana Peterson, Center Leader of the Economy, Strategy, and Finance Center here at the Conference Board. Again, I'm joined by Stephanie Richard, who is our Senior Economist of Global Indicators. We're going to turn the tables a bit and Stephanie's going to ask me questions about some of our forecasts out of the conference board. Stephanie?
Let's start with the US economy. We just talked about consumer confidence, and we see that tariffs are top of mind for consumers. So do you already see some evidence about tariffs having an impact on the economy?
Yes, but it's been quite limited. Again, the worst of the tariffs were kind of set aside for 90 days. And then they were also set aside again until August 1st. And we're not clear on all of what's going to be happening over the balance of the year, as there's still lots of negotiating going on in terms of trade deals. But for the most part, we've only seen effects of tariffs in the margins, again, because the worst of the tariffs have not been put into place. But we still do have tariffs of 10% on all goods coming into the US, as well as a 30% tariff on Chinese goods coming to the US, as well as tariffs on certain commodities like aluminum and steel. But when we look at inflation, we are seeing prices pick up for durable goods. And those are the things that you would normally ship into or rather ship from abroad and import from the US. So we've seen those prices go up, but it's not as evident in the inflation data because those price increases are being more than offset by declines in energy prices, as well as slower inflation among services. And the biggest slowdown that we've seen among services inflation is actually in housing, after we saw basically a stabilization at a pretty high level of housing inflation and shelter costs. So yes, we are seeing tariffs a little bit in inflation, but consumers are getting a break on services and certainly energy. Regarding the labor market, again, it's very difficult to see much in the way of tariffs being impacted. And we're actually not surprised by that because once tariffs were being announced earlier this year, many companies said that they would consider raising prices first before letting people go. And it seems like that's been the truth, especially many companies are, either not planning on letting people go or they're just holding on. They're in stasis to see what happens, how things shake out before they make any big moves, not only with the labor force, but also with their investments. So we haven't seen it much in the labor force, and mainly the upticks that we have seen in the unemployment rate are basically people who are being shed from jobs, industries that, were letting people go even last year, like finance and technology, and they're finding it difficult to find replacement jobs. And so they're winding up as part of the unemployed because they're not able to find new jobs. But for the most part, we're not seeing massive layoffs or a spike in the unemployment rate. Now, finally, when we look at consumer spending and business behavior, businesses definitely did stock up earlier this year, and consumers also pre-purchased items ahead of the tariffs. And we think over the last, quarter or so, businesses have been selling out of those inventories, and that's what consumers have been buying. But once businesses run out of those inventories, we think that they're going to have to stock up on goods that are subject to tariffs. And that's when we'll start seeing inflation rise and a bit of an increase in the unemployment rate.
Okay, thank you. And I guess in this context, it really makes sense that consumers are still very worried about the potential impact of tariffs, and especially on the inflation side. So Congress recently just passed this tax and spending bill. And just to give you some insight about our consumer survey, it has been mentioned in our writing responses by consumer, but it's really not the top of their concern, whether positive or negative. Like, this is not top of mind for consumers. But I wanted to ask you, so how will this impact the economy going forward? Is it a good news? Is it a bad news?
Well, it's definitely a mix, and consumers really ought to be paying attention to this. The first thing is that the bill avoided what we would call a tax cliff in 2026. Basically, the Tax Cuts and Jobs Act of 2017 had a number of provisions for individual filers and small businesses, and those provisions were set to expire January 1st, 2026. So that would, if that happened, there would have been a massive tax hike for most consumers across the US and also many small businesses. So that was avoided. So essentially, that has no impact on the economy next year because there's not going to be a tax cliff. But there are other changes in the bill that will have implications for the economy. Namely, there were some tax credits that were removed, especially for greening, which will impact not only businesses but also consumers. And you also have cuts in taxes for things like overtime, tips. So that's going to benefit consumers who, tend to work in the industries where they have to work overtime or they're dependent upon tips. Also, there are provisions for businesses like expensing of depreciation sooner rather than later, which is also going to alleviate the tax burden for them. So it's kind of a mix. So where the bill takes away from taxes, it may give in other areas. There's also significant changes to spending. There were big increases in spending on defense and also security within the US and immigration. But there are also significant cuts in areas that are a part of the social safety net, including Medicaid and SNAP. So Medicaid is for healthcare for people who don't have a lot of money, or they're senior citizens, or they're children with disabilities, or people with disabilities. And SNAP is a food benefit program for families that need help with purchasing food. So there are pretty significant cuts there. And over the next decade, starting in 2026, you'll actually see the net effect on the economy to be slightly positive from our analysis, but then it's almost completely offset in the back half with drag. So net, it's probably slightly negative over the 10-year horizon. But again, it doesn't our analysis can't account for all the different possibilities in terms of how the economy reacts to the provisions that have been put in place. So that's what we see in terms of policy changes and how it might impact the US economy.
Okay, so how is the Fed responding to these various policy changes, whether it's the tariff, the bill passed by Congress?
Yes, the Fed's been in wait and see mode. They really want to see what's going to happen in terms of the outcomes for tariffs by country. And also, they were certainly waiting for the passage of this bill. The bill has been passed, so they now can gather what the implications mean for their outlooks. But again, they have expressed that they need more data, especially to see whether or not tariffs are going to result in higher inflation, such that it causes consumers to pull back on spending materially and businesses to pull back on investment, and also laying people off. Because we think that if the economy, GDP is weak, inflation is high, but the labor market starts to fail, the Fed is going to shift its focus from inflation to the labor market. And so on balance, we do expect the Fed to continue cutting interest rates at some point, most likely in December. And so weakness in the economy and a rising unemployment rate would be one reason. But let's say on the upside that we actually see that the tariffs don't impact the economy too much this year or even next year. And so the Fed probably would not look to do anything unless they continue to see inflation slow. And if inflation continues to slow and the economy remains okay, then they can cut rates for that reason. So either way, we think that the direction of interest rate cuts is going to be down for the Fed.
Okay, so let's move away from the US, although not so much moving away from the US, because I mean, what's happening in the US clearly has an impact on the global economy. So can you just tell us a little bit how what's happening currently in the US is affecting the global economy?
Sure. So many economies spanning the globe are in the process of negotiating trade agreements with the US in order to avoid elevated tariffs. Now, we still may have a certain, minimal level of tariffs, say 10%, but many economies are trying to avoid having a 30 or 50 or 145% tariff. So with that, many economies are now economies that, may have invested in the US or, um, ship a lot of products to the US, especially China, are looking to diversify. They're looking at other markets to ship their goods to. They're also thinking about whether they want to retaliate against the US with reciprocal tariffs and export bans, et cetera. And so it's kind of running the gamut of how countries are responding. But all in all, we do think that this shift and this focus in the US on tariffs will, on balance or on the whole, reduce global GDP because you'll have fewer exports and you'll also have the demand destruction in one of the largest economies in the US. So China will export less to the US potentially, and the US will see some demand destruction that slows growth. And if you have two of the largest economies impacted by this, then that's certainly going to affect the global aggregate. But also, it's presenting opportunities for other countries to not only find new sources of business, but also to potentially negotiate tariffs that would be lower than the tariffs that China might see. And so businesses in the US might import their goods from them because they face lower tariffs.
So staying on China, so what's your expectation overall for the Chinese economy in this year and next year?
Our expectations are unchanged. The Chinese government, the authorities have indicated that their goal is 5% or around 5% GDP growth this year. And they're going to do what's necessary to achieve that. Now, we've seen mixed data over the course of this year in China, but overall, it seems like they're still headed towards the objective. But this objective definitely is being supported by fiscal and monetary policies. There's been a doubling down of investment in green products, like solar, EVs, that sort of thing. Also, further investments in getting consumers to spend. So, for example, I can't remember exactly what it's called, but it's basically like a buyback program where consumers trade in their old products and buy brand new ones to help stoke consumer spending. And also, China is very much still focused on exporting despite the fact that they are still wrangling with the US over an agreement on trade. So we still anticipate that China will meet its objective, but there's still challenges for China, and that's mainly focused around the housing market, where it still hasn't healed.
Okay, so let's move to Europe. So there was a trade deal announced over the weekend between Europe and the US, and I guess it's too early to have it reflected in our forecast, especially since we still need to hear more about the details of the deal. But so what were your expectations for Europe before the deal? And if you have any insight of how the deal may change or not change our forecast, please let us know.
Sure. So we already baked into the forecast a 10% tariff on every country. So we already had that for Europe. So depending upon the details, if its tariff is still 10%, then it really doesn't change the forecast. But if it's higher or lower, clearly that's going to have an impact on the forecast because the EU encompasses many, many economies. And also the UK is a large economy, and that's going to have together, that's going to have a material effect on the global forecast. So I think we need to see what's going to happen in terms of the details. But certainly we will continue to see increased spending on defense. And that's because the US has been encouraging or Europe to spend more, or rather NATO economies to spend more on defense. And so we're going to see that happening. And also because the US government has kind of pulled back a little bit in terms of its scope, in terms of military influence, that Europe is stepping up, realizing that they're going to have to protect their own borders.
Okay, so overall, I mean, what are the downside risks about the global outlook? I mean, you mentioned many already, but let's just summarize them.
Sure, I think the greatest downside risk is that we don't get to the end of the tariff negotiations, and that these negotiations, at least for, some of the larger economies and regions, don't turn out well, and we end up with much higher tariffs than the 10%. There's also the risk that there's still a lot of investigations in Washington around whether or not tariffs should be placed on certain commodities or things like commodities, or things like pharmaceuticals or semiconductor chips. And there's still also the risk that the US and China continue to do their tit for tat over chips and rare earths and critical minerals, where the US has restricted shipments of chips to China, and China has restricted shipments of critical minerals and rare earths. And should that widen into something more significant, then we could definitely see that negatively impacting the global economy, because chips and rare earths pretty much go in all our technology.
Okay, so are there any upside risks?
Yes, I mean, there are plenty of upsides. Again, we could have much better outcomes regarding the tariffs relative to what we, anticipated earlier this year. And so that would definitely lift a lot of the uncertainty. It might cause businesses to, unleash their potential for investments. We could see those things happening. But again, there's a lot of uncertainty right now. And so we're just going to have to wait and see.
Okay, great. Thank you, Dana.
Absolutely. Thanks, Stephanie. And so I'm going to wrap this up. This was really a great conversation. Thank you so much, Stephanie, for being with me today.
It was great to be here.
Thank you. And also thanks to all of you for listening to C-Suite Perspectives. Again, I'm Dana Peterson, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.